speaking with the companies to help you direct in the right direction?
There's still a little bit of a leftover sentiment within the investors from some of the fallout from what we saw from the high-profile accounting scandals, the Enrons, the WorldComs, and so forth. When we look at the accounting side now, when you're doing the investigation, or if somebody, as you say, somebody were to take a step up and look at the company themselves, what kind of assurances do people have now on the veracity of the numbers that are coming out, so that they're not saying, well, this is just a story that's being given to me? Just for somebody who's, not just they're managing their portfolio, or they're perhaps looking at a management firm, how can they have some confidence in that what they're receiving is actually the story?
I think ultimately you have to trust in the balance sheet that's generated, because the balance sheet doesn't lie, assuming that the auditors have to sign off on the balance sheets.
Right.
And basically, if you look at a balance sheet that's constantly generating positive cash flow and doesn't have a lot of leverage, and is compensating its employees by actually paying out cash expenses rather than using, stock options or other types
and so forth. Yes.
Exactly. It's probably a more fundamentally strong company that you can rely on.
Right.
Question for you. Now, I have to check the record on this, but I do believe that every single guest we've had on the program so far that has been talking about investing, we have at least brought up the topic of risk management. We are so driven on this because we believe that creating wealth involves a good risk management discipline. What are some of your disciplines in that area?
Have you ever heard the story where you give the same person the same stock, two different people the same stock, and one person makes money and the other person doesn't make money?
I think that's a biblical story. It's an old story.
It's an old story.
Been around a while.
But basically, our viewpoint on risk management is you have to size the position accordingly so that you are prepared to ride out. Because in today's world, everyone talks about short-term, long-term, but the reality is you have to invest with a time frame that you are comfortable with yourself.
Sure.
And if you look at it, if you size the position, if it's oversized, let's say you intended to take a 1 or 2% position and you take a 10% position, the next thing you know, it drops 10% on you due to things that are out of your control, say a macroeconomic event. Then all of a sudden you get really scared and you get shaken out of your belief. But if you size your position accordingly, that's a form of risk management.
Sure.
The other tool that we use is we tend to look at current costs rather than historic costs. A lot of people go back and look at historic costs and say, okay, I'm up this much on my investment, and therefore, I have a cushion, a margin of safety. So therefore, if it corrects, 10, 20%, I'm up 50% on my investment. I'll ride the whole thing down 20% and hope for the better. A different way to approach it is to look at it at current costs and evaluate a company from its current upside. Let's say you bought a 5% position in a company and it is now doubled. You've been very successful, and it's up 100%. So now it's 10% of your portfolio. At this point, you have to start making a decision about whether, at current market prices, is there that much appreciation to generate 10%, to be 10% of your portfolio? Because if that was the case, you probably should have bought 10% of your portfolio in the first place. So the prudent thing probably to do is to pare back to a manageable position at the current cost of what you reflect the future prospects would be.
It's really a question that we ask a lot of times when folks say, what should I do now? And a good way to evaluate that is say, if you were in cash, what would you do now?
Absolutely.
If you were in cash, would you buy what you're holding on to, or would you sell it?
Correct.
And that should help drive the decision. I think that's really what, in effect, what you're saying.
It's also a major problem that we're seeing in the sizing. How do I get into the position? And how much am I going to concentrate? A lot of people look at how much buying power they have, and they say, well, I have this much money to spend. Oh, I like that stock. Well, let's go shopping. And that's how they do it. But it sounds like your approach is very systematic. Again, that must be from the engineering or the mathematical side of the way your brain works, and we appreciate that as well. We're going to take a quick break right now, and we're going to go to investor trivia, I believe, investor trivia. So stand by, and when we get back, we're going to go through a couple of case studies, step by step, so you can get a better feel on how this process works, and maybe you can incorporate it into your own investment strategies. So stand by. Fun facts and multiple choice. Ready? What was the original name of the American Stock Exchange? Was it A, the sidewalk, B, the street, or C, the curb? Well, if you picked C, you'd be correct. It's the curb. Reason for this is because years ago, the traders would stand out on the streets of New York City and trade on the curb.
To this day, after most markets close, that term is still used. Trading on the curb is a practice where trades are settled and mistakes are corrected and missed trades are fixed by trading on the curb. Hope you've enjoyed our